America's debt machine is running out of buyers. And just when Washington needs allies the most, President Trump is picking economic fights with them.
Just that there are a lot of indicators out there that makes the bond market a little nervous, whether they're right or wrong.
For weeks now, U.S. Treasury bonds have been flashing red. What started as a quiet warning is now a full-blown alarm. The bond market is buckling, inflation risks are rising, and foreign investors are pulling back. Meanwhile, a fresh war in the Middle East has sent oil prices surging, threatening to trigger the kind of inflation shock that could tip the U.S. into a deep recession. Normally, the world would rally in moments like this, but not this time. Global powers aren't stepping in to help. They're stepping away. That leaves U.S. Treasury Secretary Scott Bessent with a mission that's looking more impossible by the day: persuade China, Japan, and Europe to keep buying American debt. But Trump's escalating trade war, raising tariffs from 1.5% to more than 14.5%, is making diplomacy almost impossible. Instead of cooperation, there's confrontation. And instead of economic relief, there's growing strain on American families. The warning signs are everywhere: a wave of inflation, a looming recession, and a world that may no longer be willing to backstop the U.S. economy. Before we dive into this unfolding crisis, make sure you subscribe so you don't miss any of our in-depth analysis on global economics. Since Trump escalated tariffs against countries around the world and 145% tariff on China, world trade has never been the same. Despite claims of de-escalation, some products from China still face over 55% tariffs, and many more are heading toward 25% or higher. That means American companies are paying much more to bring in the same goods, and those costs are passed directly to you, the consumer. Retailers like Walmart, Target, and even companies like Stanley Black & Decker are already warning they'll have no choice but to raise prices. According to Bloomberg, if these tariffs stay in place or go higher, the average American household could pay $3,800 more per year just to keep up with normal living expenses. Even more worrying, the latest retail numbers are out and they're not looking good. In May, U.S. retail sales fell by 0.9%. The second month in a row they've gone down. That's the biggest drop in 4 months, and it's a clear sign that Americans are starting to spend less. This is worrying because consumer spending is a major part of the U.S. economy. When people stop buying, everything slows down.
U.S. retail sales in May posted their biggest decline in 4 months as consumers pulled back on some big-ticket items.
If you look closely, core retail sales, which exclude things like cars, gas, and building materials, rose by 0.4%. But that number is mostly helped by an upward revision of April's data. So it's not as strong as it looks. It's not just shoppers who are slowing down. Factories are too. Manufacturing output for automobiles only grew by 0.1% in May. And if you remove vehicle production, factory activity actually dropped. That's a red flag. A healthy economy usually has strong manufacturing numbers. This shows that demand is falling not just in stores, but also behind the scenes, where goods are made. Meanwhile, import prices stayed flat, but the weaker dollar is pushing up core import inflation. That means things we bring in from other countries are getting more expensive. Put it all together, and it's a clear warning. The U.S. economy is losing momentum. If people keep pulling back on spending and factories keep slowing, we could be heading towards something much worse. Now let's take a look at China. While Americans are holding back, Chinese consumers are doing the opposite. In May, retail sales in China went up 6.4% compared to the same time last year. That's strong growth. Industrial production also rose by 5.8%, but it was actually slower than the increase in retail. That tells us something very important. China is starting to depend more on its own people to drive the economy, not just exports. This change didn't happen by accident. China's government has been pushing its citizens to spend more, and it's working. Big online shopping events like the 618 Festival, plus shopping coupons and subsidies from the government, have helped fuel a consumer boom, even during tough global times. This is exactly what the US and other Western countries have asked China to do for years. Rely more on domestic demand and less on exports. But here's the twist. Now that China is actually doing it, it may make the country stronger, not weaker. By boosting its own economy from within, China is becoming more resistant to outside pressure. It no longer has to worry as much about foreign buyers. That gives Beijing more freedom to push back on US policies. And here's a profound thought. What if China becomes both the world's top exporter and its own best customer? What's left for the US to hold over them then? Even with its shift toward local spending, China isn't planning to stop exporting. In fact, keeping exports strong is still a key part of its strategy. China recorded a $96 billion trade surplus in April, up from $35 billion in March, meaning it sells way more to the world than it buys. That's not just good for its economy. It gives China real power. While $600 billion in trade surplus is still the highest of any country in the world, it is nothing compared to what China achieved in 2024, when it had a trade surplus of about $1 trillion. According to the Financial Times, it was this impressive trade surplus that motivated Trump to start this tariff war in the hope that the United States could get the same results as China. Why? Because the more the world depends on Chinese goods, phones, electronics, cars, solar panels, batteries, the harder it becomes for any country, including the US, to punish China with sanctions or trade blocs. Cut off China and you risk cutting off your own supply chains. Beijing knows this. That's why it's investing so heavily in tech, semiconductors, and rare earth minerals. It wants to be the world's main supplier of things other countries can't live without. And the more it succeeds, the less it has to fear US pressure or global isolation. Think about it. If China becomes the backbone of the world's economy, who's really going to stop buying from them, even if there's a conflict? While most headlines focus on tariffs, China is quietly playing another game, this time with its currency. In the last few months, the value of the Chinese yuan has dropped from 7.3 to $1 in January to 7.1 in June compared to the US dollar and other currencies. That might not sound like much, but it makes a huge difference. When the yuan gets weaker, Chinese products become cheaper for people in other countries. So even if the US adds tariffs, the price of Chinese goods doesn't rise as much as you'd expect. In some cases, it barely rises at all. This isn't just about price, it's about survival. A weaker yuan helps Chinese exporters stay competitive. It also encourages transshipment, a sneaky tactic where Chinese goods are sent to other countries first, like Vietnam or Mexico, then labeled as if they were made there and shipped to the US. This helps Chinese companies get around tariffs entirely. The US government is trying to crack down on this, but it's incredibly hard to track and stop. Why this situation is disturbing is because in May, the US and China agreed to pause the tariff war for 90 days. The highest tariffs were pulled back a little. The US dropped rates from 145% to around 30%, and China cut its retaliatory tariffs to 10%. Wall Street cheered, stocks went up, but the truth is, these tariffs are still extremely high by historical standards. And it gets even more disturbing because even more recently, the Trump administration claims there is now a deal with China, but this deal means tariff goes up from 30% up to 55%. So would we say this is a better deal for consumers? In truth, nothing fundamental was resolved. China didn't agree to end tech subsidies. The US secured no real gains on intellectual property protections. All the big issues were simply postponed. This wasn't a deal. It was a ceasefire dressed up as progress. And the clock is ticking. That 90-day pause ends in August. If talks stall, tariffs could return with even more force. This time, the consequences will be harder to absorb. Retailers have already exhausted their older, pre-tariff inventory. What comes next? Priced under the new, heavier rates, could deliver a direct shock to supply chains and bottom lines. While Washington debates debt ceilings and tariffs, American businesses are gasping for cash. Jeffrey Gundlach, the so-called bond king, has issued stark warnings about a creeping liquidity crisis across corporate America. One of the factors he blames is the tariffs. Under current law, tariffs must be paid in full, upfront, and in cash. There's no credit, no delay, and no workaround. In May 2025, businesses paid $22.3 billion in tariff obligations, money that could have funded R&D, payroll, or supply chain resilience. Instead, it's being siphoned off into government coffers. This strain is made worse by tightening consumer behavior. Retail sales have fallen for 2 consecutive months, and the real economy is decelerating. As consumers retreat and input costs rise, companies are burning through cash faster than they can replenish it. One might expect that corporate bond spreads, the yield difference between safe and risky borrowers, would widen under such uncertainty. Instead, they remain stubbornly narrow, at around 3%. This is not a sign of strength, but of mispricing of risk, a calm before what could be a very violent storm. The next shoe to drop? A wall of corporate debt falling down the credit ladder. Analysts now predict that starting in July, $50 billion in corporate bonds will be downgraded from investment grade to junk, a financial death sentence for many firms. The implications are profound. A downgrade to junk status instantly raises borrowing costs, often by 200 to 400 basis points, which can turn debt refinancing into a death spiral. Once in junk territory, companies lose access to the largest pools of institutional capital, including pension funds and conservative investment vehicles. And the timing could not be worse. The Federal Reserve, still battling entrenched inflation, has shown no signs of easing rates. Meanwhile, geopolitical shocks are driving energy prices skyward. The 13% spike in WTI crude oil, triggered by the Israel-Iran flare-up, is more than a headline. It's a direct tax on logistics, production, and ultimately, consumer prices. In this environment, defaults don't occur one at a time. They add up. One firm misses a payment, lenders tighten standards, and credit freezes. The cycle feeds itself exactly as it did in 2008. But this time, the trigger isn't subprime mortgages. It's junk debt, tariffs, and inflation. Where does this leave us? One anonymous White House advisor recently described Trump's approach as, "Just send them a letter." This flippant style may score short-term political points, but it is dismantling decades of commercial diplomacy and supply chain trust. Compounding this is the escalating Middle East crisis. Oil markets are once again weaponized. The fragile peace between Israel and Iran shattered overnight, sending oil prices rocketing and transportation costs surging. The inflation shock is already feeding into logistics and food prices, especially in import-heavy economies like the US. Meanwhile, long-term economic models are ringing alarm bells. The Penn-Wharton budget model, an influential nonpartisan economic simulation tool, projects that if tariffs remain at current levels, US household consumption could decline further. The longer the tariffs remain, the deeper the erosion. Inflation in 2025 is expected to remain volatile, driven by rising energy prices, persistent global supply chain disruptions, and continued geopolitical instability, particularly from the Middle East. With oil prices spiking again, transportation and food costs could surge. Meanwhile, US tariffs on Chinese goods are feeding into higher consumer prices at home. Core inflation may stay above the Fed's 2% target, potentially hovering over 3% annually. If corporate liquidity weakens further and wage growth stalls, stagflation, which is a toxic mix of inflation and stagnation, could become a dominant risk by year-end. The storm isn't over. It's only beginning. If the dollar loses its backers abroad and inflation erodes trust at home, then the real crisis won't be tariffs or trade wars. It'll be confidence. And once that's gone, recovery becomes a lot harder. We'll be following every twist in this fast-moving story. So if you want clear, no-nonsense analysis on the global economy, make sure to subscribe and turn on notifications. You won't want to miss what's coming next.